All right, this is great lead into some of the strategies that you do manage at Simplify. So let's get into some of your pro picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information.
Well, the fund that I manage directly is called CDX. It is a high-yield fund. I'm very attracted to high yield for reasons that were articulated by one of my good friends, David Einhorn. In talking about my work, he emphasized that he was investing in companies that have endogenous return characteristics. In other words, he expects the companies themselves to buy back shares or pay dividends to allow him to meet his target return. He's not focused on relying on others to make the investment and buy the stock from him at a higher price. That is a change in strategy. David's traditional strategy would be to identify deeply undervalued securities. By virtue of him buying those deeply undervalued securities, that would attract others to bid up the price of those and normalize the price at a more rapid than normal rate, contributing to excess returns. He recognized that shrinking pool of active managers and shrinking pool of incremental flows into hedge funds meant that there was no more, cavalry coming to the rescue on those individual names. And so he refocused around that endogenous cash flow concept. I simply take that a step further and say, when you invest in high yield, you are actually investing in an asset class that has extraordinary endogenous cash flow. As a high yield investor, you typically receive between 25 and 30% of your fund in any given year paid back to you in the form of cash. That's a combination of the relatively high coupon that you're receiving, as well as the maturities of the individual securities that you own. A bond matures, you receive back the principal that allows you to make a subsequent investment decision into something else. That endogenous cash flow reduces the impact of passive strategies, but because high yield companies are riskier, there is an equity-like component that plays very well into my passive theories. I use that to largely construct a hedge for the high yield fund that protects me for the most part against widening credit spreads and does so at very little cost. So I'm actually able to protect my investors against drawdowns like we saw in March, April of this past year, while allowing them to participate in the higher coupon and income associated with high yield.
And you do that how? Because if you look at the chart, it's a little messy around that March, April time period. Like, explain what was going on there.
Yeah, so that's actually a really interesting time period. So first of all, my guess is you're looking at a price chart and not a total return chart.
That's right.
Okay, so one of the really critical things to understand is that we distribute about an 8.5% dividend on an annual basis. That's effectively passing through the returns associated with the hedge and the high yield. So for the price to be relatively flat is not indicative of the return of the portfolio. The second thing is, in that March, April time period, this fund was relatively illiquid. And unfortunately, we had an individual who attempted to buy the shares at the close without using a market limit order. They were picked off in the low liquidity environment. The market maker sold it to them at an 8% premium to NAV, which then subsequently corrected the next day. So that 8% end of day jump on April 8th and the subsequent decline on the next day when it traded back to NAV, net asset value, which is what you should be tracking your ETFs against, created roughly a quarter of all the volatility that my fund has experienced over the last year. So I was very angry with my market makers that occurred. That was a phone call that involved me not being nearly as polite as I am on this podcast.
Mr. Flow. So you know all about that. And so again, it's more of for an investor that's looking for income, high yield, but stability, because sometimes you think about high yield, that comes with additional risks.
Yeah, and I think that's actually very true today. High yield is benefiting from the interest rate increases from the Federal Reserve that's raised the coupon that we're receiving. If we go back to 2020, the coupon on high yield would have been somewhere 2019 to be more fair. the coupon on high yield would have been somewhere in the 4.5% range. Today, that number is closer to 8%. And so we've benefited from the increase in interest rates. And as the Fed is anticipated to cut interest rates, high yield should benefit from those interest rate cuts. The question becomes, why does the Fed cut interest rates? If the Fed cuts interest rates for economic reasons or distress reasons, then high yield has that equity-like exposure and unfortunately can experience what's called credit spread widening, or an increase in the riskiness of the individual bonds relative to government bonds. And that's really what I'm trying to protect investors against.
You've also brought two ETFs, the gold strategy one and the commodity strategy one. And before we explore both of those, I wonder if you could just give us your quick 30 seconds on your approach to commodities, because you've got kind of an easy to understand framework on commodities you're willing to go long and ones that you think are not worth it.
Well, I think the single most important thing for people to recognize is that on a global basis, we're seeing significant declines in population growth. The UN forecast for population that most people are familiar with anticipate, embed in their forecast an extraordinary increase in the fertility rates, recovery back towards historical norms. That means that the UN forecasts are actually wrong and have been wrong for a long time. They continue to downgrade them. There is a very high probability the global population is going to peak somewhere around 2035. When you think about commodities that service humans, commodities are typically consumed on a unit basis in what's called a pantry effect. As an individual, you need X amount of steel, you need X amount of copper, you need X amount of gasoline, you need X amount of food. If the unit number of humans is not rising very much, I don't anticipate demand for those commodities to rise significantly. And at the same time, in many of those commodities, we're introducing extraordinary productivity investments. I know most of your audience is going to hear me say lab-grown meat and say, oh my God, that's disgusting. I would never eat that. Have you seen the list of ingredients? You know, if you look at a Beyond Meat burger, for example, it will say it contains, lysophized acids and fats and pea protein and all sorts of stuff. Well, the simple reality is that's just our truth in labeling laws, right? It is beef. It is effective, and particularly when it is genetically grown beef, which we are moving rapidly towards, it literally will be beef. But it will have a list of ingredients that would roughly match what the list of ingredients if you put a cow through a separation process, you would effectively discover that the cow has a significant quantity of oats in it, and it has a significant quantity of cellulose, and that it has a significant quantity of fatty acids, and all those sorts of things that are listed on the Beyond Meats category. The reality is that it takes 16 units of grain to produce 1 unit of beef. When you move to a lab-grown system, it doesn't require anywhere near that. It becomes much more efficient at growing those proteins. And so not only are we not seeing the population grow, but we're actually seeing technologies emerge that further reduce the demand for many of those basic foodstuffs by eliminating animal husbandry or reducing animal husbandry. This is a long-term forecast. I want to be very, very clear on this, right? But it is a forecast within a reasonable amount of time. And we are actually seeing these components play through as the price of beef spikes in a post-COVID event environment. During COVID, if you remember, prices fell. And as a result, many farmers slaughtered their herds. It takes roughly 3 years to take a cow from calf to, from insemination to slaughter. And guess what? 3 years after the COVID trough, we're now seeing beef prices spike because we're discovering that there's a shortage of beef. That in turn is generating substitution. We've already seen pork prices collapse because that is roughly an 18-month cycle. Chicken prices collapsed in roughly 12 months. Egg prices are now collapsing because once you begin to replace the chickens and you decide not to slaughter them for a shortage of chicken for poultry, you discover that you've got egg laying capacity, right? So all of these things flow through in a definable time period that helps to explain much of the phenomenon that we're seeing, but it contributes, those high prices ultimately contribute to the adoption of substitutes, which in turn is ultimately destroying demand for commodities that I broadly group together as human food. That would include grains, that would include meats, that would include agricultural land, for example. Machine food, on the other hand, is exploding. And machines are unlike humans. Humans can get their energy from multiple diverse sources. We heat our homes with natural gas, and we heat ourselves through caloric intake, beef, pork, chicken, beans, vegetables, etc. Right? Lots of different things can contribute to our caloric intake. Machines need one thing: electricity. And so commodities associated with electricity production, to me, are a long-term structural buy.
And so is that expressed in the ETF that you guys run over there hard? Like those kind of hard, food is softs. I think you've made me a vegetarian after that conversation.
There you go. See, you've reduced demand.
There we go. Yeah, it was that simple. Talk to me about that, the hard ETF, and whether that is a nice expression of what you're talking about.
Well, the benefit of hard is that ultimately it's not tied directly to the insights that I'm offering you. And so, among other things, understand that I'm offering a relatively long-term forecast, but it is influencing short-term markets. Hard is structured very similar to another one of our funds, CTA, which is much larger. CTA is a traditional managed futures strategy, effectively a trend-following type strategy, in which we basically stop questioning why are prices going higher. We simply ask, how sustainable does this appear? Does it match up against fundamental components? Things like those cycles that I talked about, a 36-month maturation cycle for beef, or 18 months for pork, or 12 months for chicken. It's actually even shorter for chicken. Those factors are embedded in the model, and then we are simply following the prices in a trend-following framework that removes the potential idiocy and overconfidence from Mike Green and puts it in the hand of a machine that is constantly reevaluating this and considering it across a basket of commodities. In the case of hard, commodities, interest rate exposures, and a few other components within CTA. Hard, the unique feature that we've added here is just that we have effectively forced the system to be long commodities. And so, if you have a fiduciary responsibility as a machine to be long commodities, just like passive investing, you are going to do it. But you're going to select the ones that are showing the most positive trends, characteristics, fundamentals, carry, which is a significant component associated with managed futures strategies and didn't really exist prior to the interest rate increases that we've seen from the Federal Reserve. All of those are factors that are playing into how hard is allocating its capital. And it does happen to express things often very similar to the way that I'm thinking about them.
I want to talk about your the gold strategy income ETF, YGLD. That one, we don't need to debate about it. That one has done extraordinary compared to gold bullion. Why? What is the extra layer that you add to it? How do you affect that income strategy? And because this ETF has only been around for a couple of years, how does it perform? Or how is it meant to perform in a downturn if we get a pullback?
So very quickly, YGLD is gold yield that's generated by selling call options on gold itself. And so in an environment in which gold is being bid up primarily by retail investors that are chasing levered expressions of that through options, that drives up the premium associated with those options and basically allows us to sell further out of the money options to generate the same yield or to generate higher yield by selling the same strike options. That allows us to monetize much of the move that's occurred in gold. And because it has been it's certainly been a dramatic advance, but relative to the implied volatility for gold, it's actually been a fairly favorable environment for selling those options. If there were a downturn that would occur, the return profile of YGLD would be cushioned relative to the return of gold because you are generating that income. Again, I want to encourage people, make sure when you're looking at any of these charts that you're looking at a total return expression as compared to a price expression. Because when you are paying out distributions, you're going to reduce that net asset value, and prices will ultimately reflect that net asset value, not the returns of the product.
Thank you so much, Michael, for sharing your time and your insights with us. I've certainly learned a lot. As I said, I'm probably vegetarian now, but I really appreciate it.